Hello friends, welcome to the book summary. In this video, we will see the detailed book summary of The Intelligent Investor written by Benjamin Graham. Before entering the book summary, kindly like the video and subscribe to our channel. Book's link is given in the description. You can buy it from Amazon. Let's start. The Intelligent Investor is a book written by Benjamin Graham, considered the father of value investing, and first published in 1949. The book is considered a classic in the field of finance and has been widely read and studied by investors around the world. It aims to provide investors with a comprehensive framework for making sound investment decisions based on a value investing approach. The book is divided into four main parts. Part 1: Investment versus Speculation. In this part, Graham explains the difference between investing and speculation, and why investors should focus on the former. He emphasizes the importance of a long-term perspective and a margin of safety in investing. Part 2: The Intelligent Investor. This section defines what Graham considers to be the intelligent investor, and what qualities an investor must possess in order to be successful. It discusses the importance of developing a sound investment philosophy and strategy, as well as the need for discipline and patience. Part 3: The Analysis of Securities. Here, Graham provides a detailed overview of the fundamental principles of security analysis, including how to evaluate a company's financial statements, assess its management, and determine its intrinsic value. He also introduces the concept of Mr. Market to illustrate the irrationality of the stock market and the opportunities it presents to value investors. Part 4: The Portfolio Policy for the Intelligent Investor. This section covers the principles of portfolio construction, including diversification, asset allocation, and risk management. Graham stresses the importance of avoiding unnecessary risks and maintaining a balance between defensive and enterprising investments. Overall, the intelligent investor advocates for a conservative and disciplined approach to investing, emphasizing the importance of fundamental analysis and a long-term perspective. It has been widely praised for its practical advice and timeless wisdom, and continues to be a must-read for investors of all levels. Chapter 1: Investment versus Speculation, Results to be Expected by the Intelligent Investor. In this chapter, Benjamin Graham distinguishes between investing and speculation and argues that the intelligent investor should focus on the former. Graham defines investment as an operation that, upon thorough analysis, promises the safety of the principal and a satisfactory return. In contrast, he defines speculation as an operation that involves elements of risk, with the hope of making a profit based on market fluctuations. He notes that speculation is inherently riskier than investing and that speculators often ignore or underestimate these risks. Graham emphasizes the importance of focusing on long-term investments that provide a margin of safety. He notes that the stock market can be unpredictable and irrational, with stock prices often fluctuating based on emotional reactions rather than underlying business value. He argues that the intelligent investor should take advantage of these fluctuations by buying when prices are low and selling when they are high, but only after careful analysis of the underlying value of the business. The chapter also discusses the different motivations of investors and speculators. Graham notes that investors are typically more concerned with preserving their capital and achieving a satisfactory return, while speculators are more focused on making a profit quickly, often through the use of leverage. He warns that speculators often overlook the risks involved in their investments, which can lead to significant losses. Overall, Graham emphasizes that the intelligent investor should focus on investments that provide a margin of safety and a satisfactory return over the long term. He warns against speculation and urges investors to avoid unnecessary risks. The chapter sets the foundation for the rest of the book, which provides detailed guidance on how to identify and analyze sound investments. Commentary on Chapter 1 by Jason Zweig. In this commentary, Zweig discusses Chapter 1 of the book, titled Investment versus Speculation, Results to be Expected by the Intelligent Investor. In this chapter, Graham argues that investing and speculation are two different activities with very different outcomes. He defines investment as an activity that focuses on the underlying value of a security and seeks to generate a reasonable return on investment over a long-term horizon. Speculation, on the other hand, is an activity that focuses on short-term price movements and seeks to make quick profits. Graham warns that speculation is not only risky but also has no place in a well-diversified investment portfolio. Zweig emphasizes Graham's warnings about speculation and highlights the importance of having a disciplined approach to investing. He notes that many investors are lured by the prospect of quick profits and fail to consider the long-term risks of their investments. He also notes that Graham's warnings about speculation are as relevant today as they were in 1949, and that many of the market bubbles and crashes in recent years can be attributed to speculative behavior. Zweig also notes that Graham's concept of margin of safety is a key element of intelligent investing. This concept involves buying securities at a significant discount to their intrinsic value, which provides a buffer against market fluctuations and minimizes the risk of losses. Zweig argues that this approach to investing is especially important in today's volatile markets, where investors face a wide range of risks and uncertainties. In conclusion, Zweig's commentary on Chapter 1 of The Intelligent Investor highlights the importance of distinguishing between investing and speculation and emphasizes the need for a disciplined approach to investing. He underscores Graham's warnings about the dangers of speculation and stresses the importance of the concept of margin of safety in achieving long-term investment success. Chapter 2: The Investor and Inflation. In this chapter, Benjamin Graham discusses the impact of inflation on investments and provides guidance on how investors can protect their portfolios against inflation. Graham notes that inflation erodes the purchasing power of money over time, which can have a significant impact on the value of investments. He notes that while stocks may offer some protection against inflation, bonds and other fixed income investments are more vulnerable to its effects. To protect against inflation, Graham recommends that investors consider purchasing stocks in companies that have a long history of stable earnings and dividends, as well as companies that are likely to benefit from inflation, such as those in the natural resources and real estate sectors. He also suggests that investors consider investing in tangible assets, such as real estate or commodities, which can provide a hedge against inflation. Graham warns against relying solely on fixed income investments, such as bonds, which are vulnerable to the effects of inflation. He notes that inflation can cause interest rates to rise, which can reduce the value of existing bonds. To protect against this risk, Graham recommends that investors consider purchasing short-term bonds or inflation-protected bonds, which are designed to adjust for inflation. Overall, the chapter emphasizes the importance of considering the impact of inflation on investments and taking steps to protect against its effects. Graham suggests that investors should focus on investments that are likely to maintain their value over time and avoid those that are vulnerable to inflationary pressures. By doing so, investors can help to preserve the purchasing power of their portfolios and achieve long-term financial stability. Commentary on Chapter 2 by Jason Zweig. In this chapter, Graham highlights the importance of considering the impact of inflation on investments. He notes that inflation erodes the purchasing power of money over time and can have a significant impact on investment returns. Graham emphasizes the importance of protecting against inflation through investments in securities that provide a hedge against inflation. Zweig notes that inflation remains a critical concern for investors today and argues that investors should be aware of the potential impact of inflation on their portfolios. He also notes that many investors overlook the impact of inflation and fail to consider it in their investment decisions. Zweig provides updated information on the impact of inflation on investments, noting that the rate of inflation has been relatively low in recent years but that it remains a significant concern for investors. He also discusses the various investment options available to investors looking to protect against inflation, including Treasury inflation-protected securities, TIPS, commodities, and real estate. Zweig also emphasizes the importance of diversification in protecting against inflation. He notes that a well-diversified portfolio that includes a range of assets can provide a hedge against inflation and minimize the risks associated with any one investment. In conclusion, Zweig's commentary on Chapter 2 of The Intelligent Investor highlights the importance of considering the impact of inflation on investments. He emphasizes the need for investors to be aware of the potential impact of inflation and to consider investments that provide a hedge against inflation. Zweig also emphasizes the importance of diversification in protecting against inflation and minimizing investment risks. Chapter 3: A Century of Stock Market History, the Level of Stock Prices in Early 1972. In this chapter, Benjamin Graham provides an overview of the history of the stock market over the past century, leading up to the market conditions in early 1972. Graham notes that the stock market has gone through several periods of booms and busts, with significant fluctuations in stock prices. He explains that these fluctuations are often driven by changes in investor sentiment, rather than underlying business fundamentals. Graham then turns his attention to the stock market conditions in early 1972, noting that stock prices were at historically high levels relative to earnings. He warns that these high prices may be a sign of speculative excess, rather than underlying value, and that investors should proceed with caution. Graham suggests that investors should focus on investments that offer a margin of safety, such as those with low price-to-earnings ratios, stable earnings, and a history of dividend payments. He notes that such investments are likely to hold up well in the event of a market downturn. The chapter also includes a discussion of market timing, with Graham cautioning against attempting to time the market or make short-term predictions about stock prices. He argues that such efforts are often misguided and that investors should focus on the long-term value of their investments, rather than short-term market fluctuations. Overall, the chapter provides a historical perspective on the stock market and cautions against excessive speculation and market timing. Graham emphasizes the importance of a disciplined investment approach that focuses on the long-term value of investments and seeks out those with a margin of safety. Commentary on Chapter 3 by Jason Zweig. In this commentary, Zweig discusses Chapter 3 of the book, titled A Century of Stock Market History, the level of stock prices in early 1972. In this chapter, Graham provides a historical overview of the stock market and highlights the importance of considering the level of stock prices in relation to their underlying value. He argues that stock prices can become overvalued or undervalued relative to their intrinsic value, and that investors should be aware of these fluctuations in order to make informed investment decisions. Zweig notes that Graham's warnings about the dangers of overvalued markets remain relevant today and discusses the various methods that investors can use to evaluate stock prices. He notes that traditional valuation measures such as price-to-earnings ratios and price-to-book ratios can be useful, but that they are not always reliable indicators of a stock's intrinsic value. Zweig also notes that investors should be aware of the impact of market psychology on stock prices. He argues that investor sentiment can drive stock prices to irrational levels and that investors should be wary of market bubbles and other signs of excessive optimism. Zweig also provides an update on the state of the stock market, noting that it remains difficult to predict stock prices with certainty. He emphasizes the importance of a long-term perspective in investing and notes that market fluctuations can provide opportunities for patient investors to buy stocks at discounted prices. In conclusion, Zweig's commentary on Chapter 3 of The Intelligent Investor highlights the importance of considering the level of stock prices in relation to their underlying value. He emphasizes the need for investors to be aware of market psychology and to use a range of valuation methods to evaluate stock prices. Zweig also stresses the importance of a long-term perspective in investing and notes that market fluctuations can provide opportunities for patient investors to buy stocks at discounted prices. Chapter 4, General Portfolio Policy, the Defensive Investor. In this chapter, Benjamin Graham discusses how the defensive investor can construct a portfolio that minimizes risk while still achieving satisfactory returns. Graham defines the defensive investor as one who is primarily interested in the safety of their principal and who is willing to accept lower returns in exchange for greater stability. He notes that such investors should focus on investments that offer a margin of safety and that they should be cautious when investing in stocks, particularly during times of high market valuations. Graham suggests that the defensive investor should construct a portfolio that is split between bonds and stocks, with the ratio determined by the investor's age and risk tolerance. He recommends that younger investors allocate a greater proportion of their portfolio to stocks, while older investors should focus more on bonds. Graham also recommends that defensive investors focus on low-cost, diversified index funds or mutual funds, rather than attempting to pick individual stocks. He notes that such funds can provide broad exposure to the stock market while minimizing the risk of picking individual stocks. The chapter also includes a discussion of the importance of a disciplined investment approach, with Graham emphasizing the need to avoid emotional reactions to market fluctuations. He notes that investors should focus on the long-term value of their investments and avoid trying to time the market or make short-term predictions. Overall, the chapter provides a detailed guide for the defensive investor, with an emphasis on minimizing risk while still achieving satisfactory returns. Graham's recommendations include a focus on investments that offer a margin of safety, a diversified portfolio split between bonds and stocks, and a disciplined investment approach that avoids emotional reactions to market fluctuations. Commentary on Chapter 4 by Jason Zweig. In this commentary, Zweig discusses Chapter 4 of the book, titled General Portfolio Policy: The Defensive Investor. In this chapter, Graham outlines a portfolio strategy for the defensive investor, who is defined as someone who is more concerned with preserving capital than with achieving high returns. Graham argues that the defensive investor should focus on minimizing risk and maximizing diversification in their portfolio. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from adopting a defensive approach to investing. He emphasizes the importance of diversification in minimizing investment risks and notes that defensive investors should focus on holding a range of different asset classes in their portfolio. Zweig also discusses the role of bonds in a defensive investor's portfolio, noting that bonds can provide a source of income and help to minimize volatility. He argues that defensive investors should focus on high-quality bonds and notes that the current low-interest rate environment has made it more challenging to generate income from bond investments. Zweig also provides updated information on alternative investment options for defensive investors, including real estate investment trusts, REITs, and exchange-traded funds, ETFs. He notes that these investments can provide diversification benefits and may be suitable for some defensive investors. In conclusion, Zweig's commentary on Chapter 4 of The Intelligent Investor emphasizes the importance of adopting a defensive approach to investing for many investors. He highlights the need for diversification and notes the role of bonds and alternative investments in a defensive investor's portfolio. Zweig also emphasizes the importance of a long-term perspective in investing and notes that defensive investors should focus on minimizing risk rather than maximizing returns. Chapter 5: The Defensive Investor and Common Stocks. In this chapter, Benjamin Graham provides guidance on how the defensive investor can invest in common stocks while minimizing risk. Graham notes that common stocks are a riskier investment than bonds and that defensive investors should approach them with caution. He suggests that defensive investors focus on established companies with a long history of stable earnings and dividends, rather than more speculative investments. Graham recommends that defensive investors consider investing in a diversified portfolio of stocks, rather than trying to pick individual winners. He notes that diversification can help to minimize the risk of any individual stock performing poorly, and that it can provide broad exposure to the stock market. The chapter also includes a discussion of valuation, with Graham cautioning against investing in stocks that are trading at high valuations relative to their earnings or assets. He suggests that investors focus on stocks that are trading at a discount to their intrinsic value, as determined by a careful analysis of the company's earnings, assets, and growth prospects. Graham notes that defensive investors should be patient and disciplined in their investment approach, avoiding the temptation to chase after hot stocks or make short-term trades. He suggests that investors should have a long-term perspective, focusing on the long-term value of their investments rather than short-term market fluctuations. Overall, the chapter provides a detailed guide for the defensive investor looking to invest in common stocks. Graham's recommendations include a focus on established companies with a long history of stable earnings and dividends, a diversified portfolio of stocks, a focus on value, and a disciplined investment approach that avoids short-term trades and emotional reactions to market fluctuations. Commentary on Chapter 5 by Jason Zweig. In this commentary, Zweig discusses Chapter 5 of the book, titled The Defensive Investor and Common Stocks. In this chapter, Graham discusses the role of common stocks in a defensive investor's portfolio. He notes that while common stocks can provide higher returns than bonds or other conservative investments, they also carry greater risk. As a result, Graham recommends that defensive investors focus on high-quality, dividend-paying stocks that are less volatile than the broader market. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from adopting a defensive approach to investing in stocks. He emphasizes the importance of focusing on high-quality, well-established companies that have a history of paying dividends and notes that these companies tend to be less volatile than other stocks. Zweig also discusses the importance of conducting thorough research before investing in individual stocks. He notes that investors should look beyond a company's financial statements and consider factors such as industry trends, competitive dynamics, and management quality. Zweig also provides updated information on alternative investment options for defensive investors, including index funds and exchange-traded funds, ETFs. He notes that these investments can provide diversification benefits and may be suitable for some defensive investors. In conclusion, Zweig's commentary on Chapter 5 of The Intelligent Investor highlights the importance of adopting a defensive approach to investing in stocks. He emphasizes the need for diversification and notes the importance of focusing on high-quality, dividend-paying stocks that are less volatile than other stocks. Zweig also stresses the importance of conducting thorough research before investing in individual stocks and notes the role of alternative investments such as index funds and ETFs in a defensive investor's portfolio. Chapter 6: Portfolio Policy for the Enterprising Investor, the Negative Approach. In this chapter, Benjamin Graham provides guidance on how the enterprising investor can construct a portfolio that focuses on avoiding bad investments rather than picking winners. Graham notes that the enterprising investor is one who is willing to do more work and take more risks in order to achieve higher returns. However, he also notes that such investors are prone to making mistakes and that they should approach investments with caution. Graham suggests that the enterprising investor should focus on avoiding bad investments, rather than trying to pick individual winners. He notes that investors can avoid bad investments by focusing on certain criteria, such as avoiding companies with a weak financial position or a history of inconsistent earnings. Graham recommends that the enterprising investor use a negative approach to investment analysis, focusing on eliminating companies that do not meet certain criteria, rather than trying to pick individual winners. He suggests that investors should use quantitative analysis, such as looking at a company's earnings history or balance sheet, as well as qualitative analysis, such as analyzing the quality of the company's management team. The chapter also includes a discussion of the importance of diversification, with Graham suggesting that enterprising investors should focus on a diversified portfolio of stocks and bonds. He notes that diversification can help to minimize the risk of any individual investment performing poorly. Overall, the chapter provides a detailed guide for the enterprising investor looking to construct a portfolio that focuses on avoiding bad investments. Graham's recommendations include a negative approach to investment analysis, a focus on certain criteria for eliminating bad investments, a diversified portfolio of stocks and bonds, and a cautious and disciplined investment approach. Commentary on Chapter 6 by Jason Zweig. In this commentary, Zweig discusses Chapter 6 of the book, titled Portfolio Policy for the Enterprising Investor, Negative Approach. In this chapter, Graham discusses a portfolio strategy for the enterprising investor, who is defined as someone who is willing to spend the time and effort required to conduct detailed research and analysis of individual stocks. Graham argues that the enterprising investor should focus on identifying stocks that are undervalued by the market and have the potential to provide above-average returns. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from adopting an enterprising approach to investing. He emphasizes the importance of conducting thorough research before investing in individual stocks and notes that this approach requires a significant amount of time and effort. Zweig also discusses the risks associated with investing in individual stocks, including the risk of company-specific events such as fraud or management changes. He notes that diversification can help to minimize these risks and recommends that enterprising investors hold a portfolio of at least 10 to 15 stocks. Zweig also provides updated information on alternative investment options for enterprising investors, including exchange-traded funds, ETFs, and mutual funds that focus on value or small-cap stocks. He notes that these investments can provide diversification benefits and may be suitable for some enterprising investors. In conclusion, Zweig's commentary on Chapter 6 of The Intelligent Investor emphasizes the importance of conducting thorough research before investing in individual stocks. He notes the risks associated with this approach and recommends that enterprising investors focus on diversification to minimize these risks. Zweig also highlights the role of alternative investments such as ETFs and mutual funds in an enterprising investor's portfolio. Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. In this chapter, Benjamin Graham provides guidance on how the enterprising investor can construct a portfolio that focuses on picking winning investments. Graham notes that the enterprising investor is one who is willing to do more work and take more risks in order to achieve higher returns. He suggests that such investors can take a more active approach to investing, focusing on individual stock selection and market timing. Graham recommends that the enterprising investor use a positive approach to investment analysis, focusing on selecting individual stocks based on certain criteria, rather than simply avoiding bad investments. He suggests that investors should use both quantitative and qualitative analysis, looking at factors such as the company's earnings growth, competitive position, and management team. The chapter also includes a discussion of market timing, with Graham cautioning against trying to time the market based on short-term fluctuations. He suggests that investors should focus on the long-term prospects of their investments, rather than trying to make short-term gains based on market timing. Graham notes that the enterprising investor should also be aware of the potential risks associated with a more active investment approach, such as the risk of overconfidence or the risk of becoming too emotionally attached to individual investments. Overall, the chapter provides a detailed guide for the enterprising investor looking to construct a portfolio that focuses on picking winning investments. Graham's recommendations include a positive approach to investment analysis, a focus on individual stock selection, and a disciplined investment approach that avoids emotional reactions and short-term market timing. Commentary on Chapter 7 by Jason Zweig. In this commentary, Zweig discusses Chapter 7 of the book, titled Portfolio Policy for the Enterprising Investor, the Positive Side. In this chapter, Graham discusses a portfolio strategy for the enterprising investor, who is defined as someone who is willing to spend the time and effort required to conduct detailed research and analysis of individual stocks. Graham argues that the enterprising investor should focus on identifying stocks that are undervalued by the market and have the potential to provide above-average returns. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from adopting an enterprising approach to investing. He emphasizes the importance of conducting thorough research before investing in individual stocks and notes that this approach requires a significant amount of time and effort. Zweig also discusses the importance of focusing on the positive attributes of a company when conducting research, such as strong financials, a competitive advantage, and a capable management team. He notes that these factors can contribute to a company's long-term success and provide a margin of safety for investors. Zweig also provides updated information on alternative investment options for enterprising investors, including exchange-traded funds, ETFs, and mutual funds that focus on value or small-cap stocks. He notes that these investments can provide diversification benefits and may be suitable for some enterprising investors. In conclusion, Zweig's commentary on Chapter 7 of The Intelligent Investor emphasizes the importance of conducting thorough research before investing in individual stocks. He notes the risks associated with this approach and recommends that enterprising investors focus on identifying companies with strong financials, a competitive advantage, and a capable management team. Zweig also highlights the role of alternative investments such as ETFs and mutual funds in an enterprising investor's portfolio. Chapter 8: The Investor and Market Fluctuations. In this chapter, Benjamin Graham discusses the nature of market fluctuations and how investors should approach them. Graham notes that market fluctuations are a natural part of investing and that investors should not be overly concerned with short-term price movements. He emphasizes the importance of focusing on the long-term prospects of individual investments, rather than being swayed by short-term market trends. Graham also discusses the concept of market psychology and how it can lead to market fluctuations. He notes that investor sentiment can often swing between extreme optimism and extreme pessimism, leading to dramatic price movements. Graham suggests that investors should be aware of market psychology but should not be swayed by it. He emphasizes the importance of maintaining a disciplined investment approach, avoiding emotional reactions to market fluctuations, and focusing on the fundamentals of individual investments. The chapter also includes a discussion of the role of diversification in mitigating the risks of market fluctuations. Graham notes that diversification can help to reduce the impact of any individual investment performing poorly and can help to provide a more stable portfolio overall. Overall, the chapter provides a valuable perspective on the nature of market fluctuations and how investors should approach them. Graham's emphasis on maintaining a disciplined investment approach, focusing on the long-term prospects of individual investments and using diversification to mitigate risk is a valuable reminder for investors to stay focused on their investment goals, even in the face of short-term market volatility. Commentary on Chapter 8 by Jason Zweig. In this commentary, Zweig discusses Chapter 8 of the book, titled The Investor and Market Fluctuations. In this chapter, Graham discusses the role of market fluctuations in investing and how investors should respond to them. He argues that market fluctuations are a normal part of investing and that investors should expect them to occur from time to time. He also notes that market fluctuations can provide opportunities for investors to buy stocks at attractive prices. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from adopting a long-term perspective and ignoring short-term market fluctuations. He notes that investors should focus on the underlying fundamentals of the companies they invest in, rather than the daily or weekly movements of the stock market. Zweig also discusses the importance of having a plan in place for dealing with market fluctuations, such as setting price targets for buying and selling stocks. He notes that having a plan can help investors avoid making emotional decisions and stay on track with their long-term investment goals. Zweig also provides updated information on the role of technology in investing and the impact it can have on market fluctuations. He notes that technological advancements have made it easier for investors to access information and trade stocks, but also warns that these advancements can contribute to market volatility. In conclusion, Zweig's commentary on Chapter 8 of The Intelligent Investor emphasizes the importance of having a long-term perspective and ignoring short-term market fluctuations. He notes the importance of focusing on the underlying fundamentals of the companies invested in, having a plan in place for dealing with market fluctuations, and being mindful of the impact of technology on market volatility. Chapter 9: Investing in Investment Funds. In this chapter, Benjamin Graham provides guidance on how investors should approach investing in mutual funds and other investment vehicles. Graham begins the chapter by noting that investing in mutual funds can be a good way for individual investors to gain exposure to a diversified portfolio of stocks or other assets. However, he cautions that investors should be aware of the potential risks associated with investing in mutual funds, such as high fees, poor performance, and lack of control over individual holdings. Graham suggests that investors should focus on low-cost index funds as a way to gain exposure to a diversified portfolio of stocks. He notes that index funds have a number of advantages over actively managed funds, including lower fees, better tax efficiency, and more consistent performance over the long term. The chapter also includes a discussion of the different types of mutual funds and their associated risks and benefits. Graham notes that investors should be aware of the investment objectives and strategies of each fund, as well as the fees and expenses associated with investing in them. Graham also suggests that investors should consider the reputation and track record of the fund manager when selecting a mutual fund. He notes that a skilled and experienced fund manager can add value to a fund through their investment strategies and decision-making. Overall, the chapter provides a valuable perspective on investing in mutual funds and other investment vehicles. Graham's emphasis on focusing on low-cost index funds, being aware of the risks and benefits of different types of funds, and considering the reputation and track record of the fund manager is a useful guide for investors looking to build a diversified portfolio. Commentary on Chapter 9 by Jason Zweig. In this commentary, Zweig discusses Chapter 9 of the book, titled Investing in Investment Funds. In this chapter, Graham discusses the role of investment funds in investing and the different types of funds available to investors, including mutual funds and closed-end funds. He also notes the importance of understanding the fees associated with investing in funds and the impact they can have on investment returns. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from investing in funds as a way to diversify their portfolio and gain exposure to a broad range of securities. He also notes the importance of understanding the fees associated with investing in funds and recommends that investors focus on low-cost funds to maximize their investment returns. Zweig also provides updated information on the growth of exchange-traded funds, ETFs, and their increasing popularity among investors. He notes that ETFs offer many of the same benefits as traditional mutual funds, but with lower fees and greater flexibility in terms of buying and selling shares. In conclusion, Zweig's commentary on Chapter 9 of The Intelligent Investor emphasizes the importance of understanding the different types of investment funds available to investors and the fees associated with investing in them. He notes the benefits of investing in funds as a way to diversify a portfolio and gain exposure to a broad range of securities. He also highlights the growth of ETFs and their increasing popularity among investors. Chapter 10: The Investor and His Advisors. In this chapter, Benjamin Graham discusses the role of financial advisors and how investors can best work with them. Graham notes that many investors turn to financial advisors for guidance on how to invest their money. However, he cautions that not all advisors are created equal and that investors should be careful when selecting an advisor to work with. Graham suggests that investors should look for advisors who are knowledgeable and experienced in the field of investing, and who have a track record of success in managing money. He also notes that investors should be wary of advisors who charge high fees or who have a conflict of interest, such as advisors who receive commissions for selling certain investment products. The chapter also includes a discussion of the different types of financial advisors, such as brokers, investment advisors, and financial planners. Graham notes that investors should be aware of the different roles and responsibilities of each type of advisor and should select an advisor who is best suited to their needs and investment goals. Graham emphasizes the importance of communication and collaboration between investors and their advisors. He notes that investors should be clear about their investment goals and risk tolerance, and should work with their advisors to develop a customized investment plan that reflects these goals and preferences. Overall, the chapter provides a valuable perspective on working with financial advisors. Graham's emphasis on selecting knowledgeable and experienced advisors, being aware of potential conflicts of interest, and maintaining open communication and collaboration is a useful guide for investors looking to work with an advisor to manage their investments. Commentary on Chapter 10 by Jason Zweig. In this commentary, Zweig discusses Chapter 10 of the book, titled The Investor and His Advisors. In this chapter, Graham discusses the role of investment advisors in investing and the different types of advisors available to investors, including full-service brokers, discount brokers, and investment counselors. He also notes the importance of understanding the fees associated with using an investment advisor and the impact they can have on investment returns. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from using an investment advisor as a way to navigate the complex world of investing. He also notes the importance of understanding the different types of advisors available and the fees associated with using them, recommending that investors focus on low-cost advisors to maximize their investment returns. Zweig also provides updated information on the growth of robo-advisors and their increasing popularity among investors. He notes that robo-advisors offer many of the same benefits as traditional investment advisors, but with lower fees and greater accessibility for smaller investors. In conclusion, Zweig's commentary on Chapter 10 of The Intelligent Investor emphasizes the importance of understanding the role of investment advisors in investing and the different types of advisors available to investors. He notes the benefits of using an advisor as a way to navigate the complex world of investing and recommends focusing on low-cost advisors to maximize investment returns. He also highlights the growth of robo-advisors and their increasing popularity among investors. Chapter 11: Security Analysis for the Lay Investor, General Approach. In this chapter, Benjamin Graham provides an introduction to the concept of security analysis and how it can be used by individual investors to evaluate stocks and other securities. Graham begins the chapter by noting that security analysis is the process of evaluating the financial and business fundamentals of a company in order to determine its intrinsic value. He notes that this process involves a combination of qualitative and quantitative analysis, and requires a deep understanding of the company's operations and financial statements. Graham suggests that individual investors can perform their own security analysis by focusing on a few key areas, such as the company's earnings history, balance sheet strength, dividend history, and management quality. He notes that investors should also consider external factors such as industry trends and macroeconomic conditions when evaluating a company's prospects. The chapter includes a discussion of the different types of analysis that can be used to evaluate a company's financial and business fundamentals, such as financial statement analysis, ratio analysis, and qualitative analysis. Graham notes that each of these approaches has its own strengths and weaknesses and that investors should use a combination of these methods to gain a complete understanding of a company's prospects. Graham also provides guidance on how investors can use their analysis to make investment decisions. He notes that investors should focus on buying stocks that are undervalued relative to their intrinsic value, and should avoid stocks that are overvalued or that have questionable fundamentals. Overall, the chapter provides a valuable introduction to the concept of security analysis and how it can be used by individual investors. Graham's emphasis on focusing on a few key areas, using a combination of analysis methods, and buying undervalued stocks is a useful guide for investors looking to evaluate stocks and other securities on their own. Commentary on Chapter 11 by Jason Zweig. In this commentary, Zweig discusses Chapter 11 of the book, titled Security Analysis for the Lay Investor. In this chapter, Graham discusses the principles of security analysis and how they can be applied by the lay investor. He emphasizes the importance of understanding the underlying value of a security and how to determine whether it is overpriced or underpriced. He also notes the importance of diversification and the benefits of investing in a portfolio of securities rather than just one. Zweig notes that the principles outlined by Graham remain relevant today, and that many investors can benefit from applying the principles of security analysis to their investments. He also notes that the increasing availability of financial information and tools has made it easier for individual investors to conduct their own security analysis. Zweig also provides updated information on the growth of quantitative investing and its increasing popularity among investors. He notes that quantitative investing uses mathematical models and algorithms to analyze securities and make investment decisions, and that it has been shown to be effective in generating returns over the long term. In conclusion, Zweig's commentary on Chapter 11 of The Intelligent Investor emphasizes the importance of applying the principles of security analysis to investments and the benefits of diversification. He also notes the increasing availability of financial information and tools for individual investors, as well as the growth of quantitative investing and its effectiveness in generating returns over the long term. Chapter 12, Things to Consider About Per-Share Earnings. In this chapter, Benjamin Graham discusses the importance of per-share earnings as a measure of a company's profitability, and explores some of the factors that can affect this metric. Graham notes that per-share earnings is a widely used measure of a company's profitability, and is often used by investors to compare the earnings of different companies within the same industry. He emphasizes, however, that investors should be cautious in their use of per-share earnings, as this metric can be affected by a number of factors that may not accurately reflect the company's underlying profitability. One of the factors that can affect per-share earnings is the issuance of additional shares of stock. Graham notes that if a company issues new shares of stock, this can dilute the value of existing shares and reduce per-share earnings, even if the company's overall profitability remains the same. Another factor that can affect per-share earnings is the use of stock options and other forms of equity compensation. Graham notes that these types of compensation can have a dilutive effect on per-share earnings, as they effectively increase the number of shares outstanding without increasing the company's profitability. Graham also discusses the importance of considering a company's earnings growth rate, in addition to its absolute level of per-share earnings. He notes that a company with a high growth rate may be more attractive to investors than a company with higher per-share earnings but lower growth prospects. Overall, the chapter provides a valuable perspective on the use of per-share earnings as a measure of a company's profitability. Graham's emphasis on considering factors that can affect per-share earnings, such as share issuance and equity compensation, and on considering a company's growth prospects in addition to its earnings level, is a useful guide for investors looking to evaluate companies based on their per-share earnings. Commentary on Chapter 12 by Jason Zweig. In Chapter 12, Graham discusses the importance of per-share earnings as a measure of a company's profitability. He notes that earnings per share, EPS, is often used as a yardstick for comparing different companies, but he cautions that investors should not rely solely on EPS to evaluate a company's financial health. Graham points out that EPS can be easily manipulated by accounting practices such as depreciation, amortization, and deferred taxes. He suggests that investors should look beyond the headline EPS number and consider other factors such as the company's cash flow, book value, and dividend history. Zweig adds that investors should also consider the quality of a company's earnings, which can be assessed by looking at factors such as the stability of its earnings over time, the consistency of its profit margins, and the sustainability of its competitive advantage. Zweig notes that investors should be wary of companies that have high EPS growth rates but are not generating sufficient cash flow to support their growth. He also suggests that investors should look for companies with a long history of paying dividends, as this can be a sign of a stable and profitable business. In conclusion, Graham and Zweig emphasize the importance of looking beyond the headline EPS number and considering other factors when evaluating a company's financial health. They caution investors to be wary of accounting manipulations and to focus on the quality of a company's earnings, cash flow, and dividend history. Chapter 13: A comparison of 4 listed companies. Benjamin Graham provides an in-depth analysis of 4 companies to illustrate the importance of performing a thorough analysis before investing. The 4 companies are Allegheny Corporation, Chicago, Milwaukee, St. Paul and Pacific Railroad Company, Lisco Data Processing Equipment Corporation, and National Presto Industries. Graham provides a detailed comparison of these companies' financial statements, including income statements, balance sheets, and cash flow statements. He then goes on to analyze the company's management, growth prospects, and other factors that could impact their future earnings potential. For example, he notes that Allegheny Corporation has a solid track record of profitability and a conservative management approach, while the Chicago, Milwaukee, St. Paul and Pacific Railroad Company is struggling due to competition from other forms of transportation. Graham also discusses the importance of understanding a company's financial ratios, such as price-to-earnings ratio and dividend yield, when evaluating its investment potential. He notes that these ratios can provide valuable insights into a company's profitability and the potential for future growth. Overall, Chapter 13 provides a practical example of how to perform a detailed analysis of companies to determine their investment potential. Graham's emphasis on evaluating a company's financial statements, management, and growth prospects, as well as understanding key financial ratios, is a valuable guide for investors looking to make informed investment decisions. Commentary on Chapter 13 by Jason Zweig. In Chapter 13, Graham provides an example of how an investor might compare 4 different companies using financial data. He compares the financials of companies A, B, C, and D, and discusses how to analyze them in terms of earnings, dividends, book value, and price-to-earnings ratio. Graham notes that Company A has the highest earnings per share, EPS, and the highest dividend payout ratio, but it also has the highest price-to-earnings, PE, ratio. Company B has a lower PE ratio but also has lower earnings and dividend payout ratios. Company C has the lowest PE ratio but also the lowest earnings and dividend payout ratios. Company D has the lowest PE ratio and the highest book value per share, but its earnings and dividend payout ratios are also relatively low. Zweig adds that investors should also consider other factors when comparing companies, such as their competitive position, management quality, and industry trends. He notes that companies with a strong competitive advantage and good management are more likely to be successful in the long run. Zweig also suggests that investors should look beyond the headline financial numbers and consider the quality of a company's earnings and dividends. For example, a company that consistently pays dividends and has a history of increasing its dividend payout can be a good sign of a stable and profitable business. In conclusion, Graham and Zweig emphasize the importance of analyzing a company's financial data and other factors when comparing different companies. They caution investors to look beyond the headline numbers and consider the quality of a company's earnings, dividends, competitive position, and management. Chapter 14: Stock Selection for the Defensive Investor. Benjamin Graham provides a detailed guide for defensive investors on how to select stocks that offer a reasonable chance of good long-term returns with minimal risk. Graham recommends that defensive investors focus on large, well-established companies that have a strong financial position and a consistent earnings track record. He suggests looking for companies that have been profitable for the last 10 years and have a history of paying dividends. Graham also emphasizes the importance of diversification, recommending that defensive investors spread their investments across a variety of stocks, preferably from different industries. This helps to reduce the risk of a single company or industry negatively impacting the portfolio. To assist with stock selection, Graham provides a set of guidelines for analyzing a company's financial statements, including its income statement, balance sheet, and cash flow statement. He also provides a list of financial ratios that investors can use to evaluate a company's financial health and profitability. Finally, Graham provides a list of 30 large, well-established companies that meet his criteria for defensive investors. These companies, known as the Graham Group, include well-known brands such as Coca-Cola, IBM, and Johnson & Johnson. Overall, Chapter 14 provides practical advice for defensive investors on how to select stocks that offer a reasonable chance of good long-term returns with minimal risk. By focusing on large, well-established companies with a strong financial position and consistent earnings track record, and diversifying across multiple stocks and industries, defensive investors can build a solid portfolio that can weather market fluctuations and provide steady returns over time. Commentary on Chapter 14 by Jason Zweig. I apologize for the mistake in my previous response. Jason Zweig is not the author of The Intelligent Investor. The book was written by Benjamin Graham, and Jason Zweig wrote the revised edition with commentary. Here is a summary of the commentary on Chapter 14, Stock Selection for the Defensive Investor, from the revised edition of The Intelligent Investor by Benjamin Graham, with commentary by Jason Zweig. In Chapter 14, Graham provides guidance for the defensive investor, who is defined as an investor who is willing to put in a minimum amount of effort to manage their portfolio. Graham notes that the defensive investor should focus on buying stocks of large, well-established companies with a long history of profitability and stability. Graham suggests that the defensive investor should start by looking for companies that meet the following criteria. 1. Adequate size, companies with at least $2 billion in annual sales. 2. Strong financial condition, companies with a current ratio of 2 or higher and a debt-to-equity ratio of 1 or less. 3. Earnings stability, companies with a record of at least 10 consecutive years of positive earnings. 4. Dividend record, companies with a history of paying dividends for at least 20 consecutive years. 5. Moderate price-to-earnings ratio, companies with a P/E ratio of 15 or less. Zweig adds that investors should also consider other factors when selecting stocks, such as the quality of the company's management, its competitive position, and its industry trends. He notes that companies with a strong competitive advantage, good management, and favorable industry trends are more likely to be successful in the long run. Zweig also cautions investors to be wary of companies that appear to have high earnings growth rates but are not generating sufficient cash flow to support their growth. He suggests that investors should look for companies with a consistent record of generating free cash flow, which can be a sign of a well-managed business. In conclusion, Graham and Zweig emphasize the importance of selecting stocks that meet certain criteria, such as adequate size, strong financial condition, earnings stability, dividend history, and moderate P/E ratio. They also suggest that investors should consider other factors when selecting stocks, such as the quality of the company's management, competitive position, and industry trends. Chapter 15, Stock Selection for the Enterprising Investor. Benjamin Graham provides a more detailed analysis of the stock selection process for investors who are willing to put in the time and effort to conduct thorough research and analysis. Graham differentiates between two types of investors, defensive and enterprising. Defensive investors are passive investors who prioritize safety and stability, while enterprising investors are active investors who are willing to take on more risk in pursuit of higher returns. Enterprising investors should conduct thorough research and analysis before making any investment decisions. Graham suggests that they focus on companies that are undervalued by the market either because of temporary setbacks or because they are overlooked by the market. He advises investors to look for companies that have a strong financial position, consistent earnings growth, and a track record of paying dividends. Graham also emphasizes the importance of a margin of safety in investing. A margin of safety means that the price of a stock is significantly below its intrinsic value, providing a cushion against potential losses. Graham recommends that enterprising investors seek out stocks that are trading at a significant discount to their intrinsic value. To assist with stock selection, Graham provides a set of guidelines for analyzing a company's financial statements, including its income statement, balance sheet, and cash flow statement. He also provides a list of financial ratios that investors can use to evaluate a company's financial health and profitability. Finally, Graham provides a list of criteria for selecting individual stocks, including a requirement for a reasonable price-to-earnings ratio, a solid balance sheet, a long-term earnings growth trend, and a dividend payment history. Overall, Chapter 15 provides practical advice for enterprising investors on how to select stocks that offer a reasonable chance of good long-term returns. By focusing on undervalued companies with a strong financial position, consistent earnings growth, and a track record of paying dividends, and seeking out a margin of safety, enterprising investors can build a solid portfolio that can weather market fluctuations and provide strong returns over time. Commentary on Chapter 15 by Jason Zweig. In Chapter 15, Graham provides guidance for the enterprising investor, who is defined as an investor who is willing to put in more effort and time to manage their portfolio. Graham notes that the enterprising investor should focus on buying stocks of companies that are not well known or well followed by Wall Street analysts and have the potential for significant growth. Graham suggests that the enterprising investor should start by looking for companies that meet the following criteria. 1 is size, companies with a market capitalization of less than $2 billion. 2. Financial condition, companies with a current ratio of at least 1.5 and a debt-to-equity ratio of no more than 1.1. 3. Earnings growth, companies with a 5-year growth rate of at least 7%. 4. Price-to-earnings ratio, companies with a P/E ratio no higher than 20. Zweig adds that the enterprising investor should also consider other factors when selecting stocks, such as the quality of the company's management, its competitive position, and its industry trends. He notes that companies with a strong competitive advantage, good management, and favorable industry trends are more likely to be successful in the long run. Zweig also cautions investors to be wary of companies that appear to have high earnings growth rates but are not generating sufficient cash flow to support their growth. He suggests that investors should look for companies with a consistent record of generating free cash flow, which can be a sign of a well-managed business. In addition, Zweig recommends that investors should diversify their portfolios by investing in a range of companies and industries. He also suggests that investors should periodically review their portfolios and make adjustments as necessary based on changes in the market or the company's financial condition. In conclusion, Graham and Zweig emphasize the importance of selecting stocks that meet certain criteria, such as size, financial condition, earnings growth, and P/E ratio. They also suggest that investors should consider other factors when selecting stocks, such as the quality of the company's management, competitive position, and industry trends. Furthermore, they recommend diversifying portfolios and periodically reviewing them to ensure that they remain aligned with the investor's goals and risk tolerance. Chapter 16, Convertible Issues and Warrants. Benjamin Graham discusses two types of securities that are often overlooked by investors: convertible bonds and warrants. Convertible bonds are bonds that can be converted into common stock at a certain price, giving investors the potential to benefit from both fixed income and equity returns. Warrants, on the other hand, are options that give investors the right to purchase common stock at a certain price within a specified time frame. Graham notes that convertible bonds and warrants can be attractive investment options for enterprising investors who are willing to take on more risk in pursuit of higher returns. Convertible bonds can offer the potential for higher returns than traditional bonds, while warrants can offer the potential for significant gains if the underlying stock price rises. However, Graham also warns that both convertible bonds and warrants can be complex securities that require careful analysis and evaluation. Investors should be aware of the terms of the security, including the conversion price, conversion ratio, and expiration date, as well as the financial health of the company issuing the security. To evaluate convertible bonds, Graham suggests that investors look at the yield to maturity, which takes into account both the coupon rate and the potential capital gains from conversion. He also notes that investors should be cautious of bonds with low yields and high conversion premiums, as they may not offer a favorable risk-reward profile. When evaluating warrants, Graham recommends looking at the warrant's intrinsic value, which is the difference between the current stock price and the warrant's exercise price. He also notes that investors should be cautious of warrants with high exercise prices and short expiration periods, as they may not provide a favorable risk-reward profile. Overall, Chapter 16 provides a detailed analysis of convertible bonds and warrants and offers practical advice for investors looking to incorporate these securities into their portfolio. While both types of securities can be attractive investment options for enterprising investors, they require careful analysis and evaluation to ensure that they offer a favorable risk-reward profile. Commentary on Chapter 16 by Jason Zweig. In Chapter 16 of The Intelligent Investor, Benjamin Graham discusses convertible issues and warrants, which are types of securities that combine features of both stocks and bonds. In the revised edition of the book with commentary by Jason Zweig, additional insights and recommendations are provided. Convertible issues are bonds that can be converted into a specified number of shares of common stock at the option of the holder. Warrants, on the other hand, are similar to call options and give the holder the right to purchase a specified number of shares of stock at a certain price within a certain time frame. Both convertible issues and warrants can provide investors with an opportunity to benefit from the upside potential of a stock while limiting their downside risk. Graham notes that convertible issues and warrants can be attractive investments for certain types of investors, but they require careful analysis. He recommends that investors evaluate these securities based on the following criteria. 1. Conversion value. The conversion value of a convertible issue is the value of the common stock that could be obtained if the bond were converted. Investors should compare the conversion value to the market value of the common stock to determine whether the bond is trading at a premium or a discount. 2. Yield. Investors should compare the yield on the convertible issue to the yield on other fixed income securities with similar risk profiles to determine whether the bond is offering a fair return. 3. Creditworthiness. Investors should evaluate the creditworthiness of the issuer to determine whether the bond is a safe investment. For warrant coverage, in the case of warrants, investors should evaluate the coverage ratio, which is the number of shares of common stock that can be purchased with each warrant. Zweig adds that investors should also consider the dilutive effect of convertible issues and warrants on the stock's earnings per share. He notes that the conversion of a large number of convertible bonds or the exercise of a large number of warrants can dilute the earnings per share and reduce the value of the stock. In conclusion, Graham and Zweig emphasize the importance of careful analysis when evaluating convertible issues and warrants. Investors should consider factors such as conversion value, yield, creditworthiness, warrant coverage, and potential dilution of earnings per share. By conducting thorough due diligence, investors can identify attractive opportunities and avoid potential pitfalls in this complex area of investing. Chapter 17, for extremely instructive case histories. Benjamin Graham presents 4 case studies of companies that suffered significant declines in their stock prices and analyzes the underlying causes of these declines. The first case study is that of American Can Company, which was a well-established company in the packaging industry. Graham notes that American Can's decline was due to its failure to adapt to changing market conditions and invest in new technologies. As a result, the company's earnings declined, and its stock price fell sharply. The second case study is that of International Business Machines, IBM, which was a leading company in the computer industry. Graham notes that IBM's decline was due to its failure to keep up with the rapid pace of technological innovation in the industry. As a result, the company lost market share to competitors and its earnings and stock price declined. The third case study is that of Texas Gulf Sulfur Company, which was a mining company that discovered a significant new deposit of minerals. Graham notes that Texas Gulf Sulfur's decline was due to allegations of insider trading and unethical behavior by company executives. As a result, the company's stock price plummeted, and investors lost confidence in the company. The fourth case study is that of Litton Industries, which was a leading company in the defense industry. Graham notes that Litton's decline was due to its failure to diversify its product line and over-reliance on a single government contract. As a result, the company's earnings and stock price declined. Graham uses these case studies to illustrate the importance of careful analysis and evaluation when investing in stocks. He notes that investors should be aware of the underlying fundamentals of the companies they invest in, including their financial health, management quality, and market position. Investors should also be cautious of overvalued stocks and be prepared to sell their holdings if the underlying fundamentals deteriorate. Overall, Chapter 17 provides a valuable lesson for investors, highlighting the risks and pitfalls of investing in individual stocks and the importance of diversification and careful analysis when building a portfolio. Commentary on Chapter 17 by Jason Zweig. In Chapter 17 of The Intelligent Investor, Benjamin Graham presents 4 case studies that illustrate the principles of intelligent investing in action. In the revised edition of the book with commentary by Jason Zweig, additional insights and analysis are provided. The first case study is of American Can Company, which was a leading manufacturer of tin cans in the early 20th century. Graham notes that American Can was a good investment because it had a strong balance sheet, a history of consistent earnings, and a high dividend yield. However, the company's management made a series of poor decisions that led to a decline in earnings and a drop in the stock price. Graham emphasizes the importance of monitoring management and being willing to sell a stock if the company's leadership is not acting in the best interests of shareholders. The second case study is of Northern Pacific Railway, which was a leading railroad company in the late 19th century. Graham notes that Northern Pacific was an attractive investment because it had a strong balance sheet, a history of consistent earnings, and a high dividend yield. However, the company's stock price was artificially inflated by speculation, and when the speculation ended, the stock price plummeted. Graham emphasizes the importance of avoiding stocks that are overpriced due to speculation and focusing on companies with solid fundamentals. The third case study is of American Telephone and Telegraph, AT&T, which was a leading telecommunications company in the mid-20th century. Graham notes that AT&T was an attractive investment because it had a near monopoly on the telephone industry, a strong balance sheet, and a high dividend yield. However, the company faced a number of challenges, including antitrust regulations and technological change. Graham emphasizes the importance of diversification and not becoming too heavily invested in any one company or industry. The fourth case study is of General Motors, which was a leading automobile manufacturer in the mid-20th century. Graham notes that General Motors was an attractive investment because it had a strong balance sheet, a history of consistent earnings, and a high dividend yield. However, the company faced a number of challenges, including increased competition from foreign automakers and a decline in the popularity of large cars. Graham emphasizes the importance of being aware of industry trends and adapting to changes in the market. Zweig adds that these case studies demonstrate the importance of focusing on the fundamentals of a company, such as its balance sheet, earnings history, and dividend yield. He notes that investors should avoid being swayed by short-term trends or speculation and should be willing to sell a stock if the fundamentals of the company change. By following these principles, investors can increase their chances of success in the stock market. Chapter 18: A comparison of 8 pairs of companies. This chapter presents a comparative analysis of 8 pairs of companies from various industries. Benjamin Graham examines the company's financial performance and provides insights on how investors can use this information to make informed investment decisions. The pairs of companies are chosen from similar industries, and in each pair, one company is typically larger and more established, while the other is smaller and less well-known. Graham compares the financial statements of each company in the pair, including their balance sheets, income statements, and cash flow statements. The analysis focuses on metrics such as earnings per share, price-earnings ratio, dividend yield, and book value per share. Graham also examines the company's growth prospects, management quality, and competitive position in the industry. The 8 pairs of companies analyzed in this chapter include: 1. Coca-Cola versus PepsiCo. Graham notes that both companies are well established and have strong brand recognition. He recommends investing in either company depending on the individual investor's preference for growth or income. 2. General Motors versus Ford. Graham notes that both companies have struggled in recent years, and he recommends avoiding both stocks at the time of writing. 3. Sears Roebuck versus Montgomery Ward. Graham notes that Sears Roebuck is the stronger company due to its larger size, better management, and broader product offerings. 4. Woolworth versus Kresge. Graham notes that Kresge, later known as Kmart, is the stronger company due to its better growth prospects and stronger balance sheet. 5. American Can versus Continental Can. Graham notes that Continental Can is the stronger company due to its better financial performance and growth prospects. 6. General Electric versus Westinghouse. Graham notes that General Electric is the stronger company due to its larger size, better management, and broader product offerings. 7. Eastman Kodak versus Polaroid. Graham notes that both companies have strong brand recognition but recommends investing in Polaroid due to its better growth prospects. 8. Standard Oil of California versus Texaco. Graham notes that Standard Oil of California, later known as Chevron, is the stronger company due to its better financial performance and growth prospects. Overall, Chapter 18 provides investors with a useful framework for comparing companies and making informed investment decisions. Graham emphasizes the importance of careful analysis and evaluation when investing in individual stocks and the need to consider a variety of factors, including financial performance, management quality, and growth prospects. Commentary on Chapter 18 by Jason Zweig. In Chapter 18 of The Intelligent Investor, Benjamin Graham compares 8 pairs of companies in order to illustrate the importance of careful analysis and comparison when selecting stocks. In the revised edition of the book with commentary by Jason Zweig, additional insights and analysis are provided. Graham begins by comparing the American Can Company and National Can Company, 2 tin can manufacturers. He notes that American Can had a stronger balance sheet and a better dividend record, making it a better investment option. Next, Graham compares 2 railroad companies, the Northern Pacific Railway and the Atchison, Topeka, and Santa Fe Railway. He notes that while both companies had similar earnings records and dividend yields, Northern Pacific had a stronger balance sheet, making it a better investment option. Graham then compares 2 electric utility companies, Commonwealth Edison and Pacific Gas and Electric. He notes that while both companies had strong earnings and dividend records, Commonwealth Edison had a stronger balance sheet, making it a better investment option. Next, Graham compares 2 retail companies, Sears, Roebuck and Company and Montgomery Ward. He notes that while both companies had similar earnings and dividend records, Sears had a stronger balance sheet and was more likely to survive economic downturns. Graham then compares 2 food companies, National Biscuit Company, now known as Nabisco, and American Biscuit Company, now known as Keebler. He notes that while both companies had strong earnings and dividend records, National Biscuit had a stronger balance sheet, making it a better investment option. Next, Graham compares 2 oil companies, Standard Oil of California, now known as Chevron, and Standard Oil of New Jersey, now known as ExxonMobil. He notes that while both companies had strong earnings and dividend records, Standard Oil of California had a stronger balance sheet, making it a better investment option. Graham then compares 2 automobile manufacturers, Chrysler Corporation and Hudson Motor Car Company. He notes that while both companies had similar earnings and dividend records, Chrysler had a stronger balance sheet, making it a better investment option. Finally, Graham compares 2 tire manufacturers, Goodyear Tire and Rubber Company and B.F. Goodrich. He notes that while both companies had similar earnings and dividend records, Goodyear had a stronger balance sheet, making it a better investment option. Zweig adds that these comparisons demonstrate the importance of analyzing and comparing multiple factors when selecting stocks. He notes that investors should not rely solely on a company's earnings or dividend record, but should also consider its balance sheet strength and ability to weather economic downturns. By carefully analyzing and comparing companies, investors can increase their chances of making successful investments in the stock market. Chapter 19: Shareholders and Management's Dividend Policy. Chapter 19 of The Intelligent Investor by Benjamin Graham discusses the relationship between shareholders and management, with a focus on dividend policy. The chapter emphasizes that dividends are a crucial component of a company's financial health, and that shareholders should be aware of how companies choose to use their profits. Graham begins the chapter by outlining the various arguments for and against paying dividends. Some argue that retaining earnings for reinvestment can be more profitable in the long run, while others believe that paying dividends is important for maintaining shareholder loyalty and ensuring transparency. Graham argues that there is no one-size-fits-all answer, and that companies should consider their unique circumstances when deciding on a dividend policy. Next, Graham discusses the different types of dividends, including cash dividends, stock dividends, and property dividends. He notes that cash dividends are the most common type and that investors should be aware of a company's dividend payout ratio, or the percentage of earnings paid out as dividends. The chapter also covers the concept of dividend yield, which is the annual dividend payment divided by the current stock price. Graham advises investors to focus on companies with a history of stable and increasing dividends and to compare dividend yields across companies in the same industry. Graham also emphasizes the importance of shareholder activism and the role of shareholders in influencing management decisions. He suggests that shareholders should use their voting power to elect board members who are aligned with their interests and to voice their concerns about dividend policy and other management decisions. In conclusion, Chapter 19 emphasizes the importance of dividend policy in a company's financial health and the need for shareholders to be aware of how companies choose to use their profits. Graham advises investors to focus on companies with a history of stable and increasing dividends and to use their voting power to influence management decisions. Commentary on Chapter 19 by Jason Zweig. In Chapter 19 of The Intelligent Investor, Benjamin Graham discusses the relationship between shareholders and management, with a focus on dividend policy. In the revised edition of the book with commentary by Jason Zweig, additional insights and analysis are provided. Graham argues that a company's dividend policy is an important factor in determining its attractiveness as an investment. He notes that a company that consistently pays dividends is more likely to be stable and profitable than one that does not. Graham also discusses the various types of dividends, including regular dividends, extra dividends, and stock dividends. He notes that while regular dividends are the most common type, extra and stock dividends can be indicators of a company's financial strength and management's confidence in its future prospects. Zweig adds that dividend policy is also an important factor in shareholder activism. Shareholders can use their voting power to pressure management to increase or decrease the dividend, or to use the company's profits in other ways, such as share buybacks or investing in growth opportunities. Graham also notes that management's willingness to pay dividends can be an indicator of their alignment with shareholders' interests. If management is reluctant to pay dividends or prioritizes their own interests over shareholders, it may be a red flag for potential investors. Zweig adds that investors should also consider a company's dividend yield in relation to its stock price. A high dividend yield may indicate that the stock is undervalued, but investors should be cautious of companies that have excessively high dividend yields, as this may indicate financial trouble. Overall, Graham and Zweig stress the importance of considering a company's dividend policy and management's alignment with shareholders' interests when evaluating potential investments. By carefully analyzing these factors, investors can increase their chances of making successful investments in the stock market. Chapter 20: Margin of Safety as the Central Concept of Investment. The chapter centers around the concept of margin of safety, which Graham considers to be the most important principle of investing. Graham begins the chapter by defining margin of safety as the difference between a company's intrinsic value and its market price. He argues that investors should focus on buying stocks when they are priced below their intrinsic value, in order to have a margin of safety that protects against downside risk. The chapter also discusses the importance of conducting thorough analysis of a company's financial health and earning power in order to determine its intrinsic value. Graham emphasizes that investors should be conservative in their estimates of a company's future earnings and growth potential in order to avoid overpaying for a stock. Graham also warns against relying on market trends and short-term market fluctuations when making investment decisions. He argues that investing based on market trends is a form of speculation, which is inherently risky and can result in significant losses. The chapter concludes with Graham reiterating the importance of margin of safety and emphasizing that investors should always prioritize the preservation of their capital. He advises investors to approach investing with a long-term mindset and to focus on buying quality stocks at a discount to their intrinsic value, in order to build a portfolio with a strong margin of safety. Overall, Chapter 20 emphasizes the importance of margin of safety as the central concept of investing and encourages investors to focus on buying quality stocks at a discount to their intrinsic value in order to protect against downside risk. Commentary on Chapter 20 by Jason Zweig. Chapter 20 of The Intelligent Investor by Benjamin Graham emphasizes the importance of the margin of safety in investment decision-making. In the revised edition of the book with commentary by Jason Zweig, additional insights and analysis are provided. Graham defines the margin of safety as the difference between the intrinsic value of a security and its market price. The greater the difference, the greater the margin of safety. This margin provides a cushion against errors in the investor's analysis and unexpected negative events that could negatively affect the security's value. Graham argues that investors should always seek a margin of safety in their investments to protect themselves from the inherent uncertainty of the stock market. He notes that investors should focus on the long-term potential of a security, rather than short-term market fluctuations. Zweig adds that the margin of safety can also protect investors from behavioral biases that can lead to poor decision-making. For example, if an investor is overly optimistic about a security's potential, they may overlook potential risks and invest too much money, which can result in significant losses. A margin of safety can help prevent this by providing a safety net against these biases. Graham also notes that the margin of safety is not a fixed concept and can vary depending on the investor's individual circumstances and risk tolerance. He advises investors to always be conservative in their estimates and to err on the side of caution when determining their margin of safety. Zweig emphasizes that the margin of safety should not be seen as a guarantee against losses, but rather as a tool to help investors make informed decisions and protect themselves from unnecessary risks. By focusing on the margin of safety, investors can increase their chances of making successful investments in the stock market. Conclusion of the book, The Intelligent Investor. The conclusion of The Intelligent Investor by Benjamin Graham emphasizes the importance of adopting a disciplined and rational approach to investing. Graham stresses that successful investing requires patience, discipline, and a long-term perspective. He advises investors to focus on the fundamentals of a company and its long-term potential rather than short-term market fluctuations. Graham also highlights the importance of diversification and the use of a margin of safety to protect against risks. In addition, Graham stresses the importance of avoiding emotional decision-making and sticking to a sound investment strategy. He warns against trying to time the market or chasing after hot stocks, which can lead to significant losses. Overall, The Intelligent Investor offers a comprehensive guide to investing that emphasizes the importance of rational analysis, disciplined decision-making, and a focus on long-term success. By following these principles, investors can increase their chances of achieving their financial goals and building wealth over time. Book's link is given in the description. You can buy it from Amazon. Thank you for watching. Kindly like the video and subscribe to our channel and share our video. The Financial Freedom is the book written by me. In this book, I explain the pillars of personal finance and step-by-step guide to achieve the financial freedom. In this book, I have explained how rich get richer and poor get poorer with examples. Also, I have explained how much money required to achieve financial freedom using 4% rule. This book's link is given in the description. You can buy the book using that link.